The Trump administration spurring fears of tightening chip trade rules as well. The potential changes adding to those other mounting risks for NVIDIA. The chip maker is also facing pressure tied to customer supermicro computer as it slashed its revenue and profit outlook for the third quarter. Here to decode what's ahead for semiconductors, including NVIDIA, we've got KeyBank Capital Markets equity research analyst John Vinh. John, it is always great to catch up with you. And I want to get your take first on this view of NVIDIA here, that we're going to continue to see this migration to more customized chips or contract-made chips from the likes of Broadcom. And it does seem like some of the sentiment is piling up against NVIDIA here.
Yeah, I think that view is a little bit more premature at this point in time. We think we are still in the very early stages of generative AI. The view that it's a zero-sum game between whether someone's going to go with a custom AI chip or with a merchant GPU from NVIDIA, I don't think we're quite there yet. If the market starts to mature and we're in the latter innings, then you've got to be more mindful about what that split looks like. But at this point, it's very early stages, and NVIDIA is so far ahead of the competition. Broadcom does have a flagship customer in Google's TPU, which is a very competitive chip. But outside of the Google TPU, there are limited proof points out there of another customer having a competitive chip to what NVIDIA offers or what Google makes with Broadcom.
John, there was another headline that certainly got attention. I want your take on this one. Reuters reported, and this was late yesterday, that Trump officials are working to change a Biden-era AI trade rule, capping access to U.S. AI chips, potentially making it stricter. I'm wondering, John, listen, you're an NVIDIA investor, you read that, what should you make of a headline like that?
Yeah, I think there's certainly a lot of angst around the quote-unquote the diffusion rule, right? It's supposed to go into effect in mid-May. I want to say May 17th, May 18th, right? And I think there is some rightfully consternation around it, because what it is in effect trying to limit is the ability or of the U.S.'s competitors or rivals to get access to NVIDIA's GPUs, right? Obviously we've got a straight direct ban on China, but we also know that there is a gray market in which our competitors, including Chinese constituents, are able to get access to NVIDIA GPUs through other gray market channels by importing them through other countries. So yeah, I think there is some angst and consternation. In terms of how it kind of plays out is unclear, right? I mean, I've seen the same headlines as you that they're reconsidering it, but we'll have to see how it plays out. But it is certainly a concern and a little bit of a near-term overhang on NVIDIA stock at this point.
So, John, bottom line, is NVIDIA still a buy or even more of a buy at these levels after the declines it's seen?
I certainly believe so. The valuation is not fully pricing anything in. I think if you look at out your numbers, it's trading at less than 20 times earnings historically. I mean, NVIDIA is traded 35, 45 times, 35 to 40 times, and it's trading at a pretty significant discount. You've got the China chip ban. So we've taken, $12 billion out of our numbers this year. So you could argue that a lot of that is de-risked. So at these levels, it's not pricing in a whole lot. And we still believe that they are significantly ahead of their competitors at this point. With this new platform that they're rolling out, GB200 NVL72, they have certainly put a lot of room between themselves and their nearest competitors.
All American businesses will someday require or transform into artificial intelligence factories, or businesses that generate both goods and AI, according to NVIDIA CEO Jensen Huang, who also predicted that this will result in the creation of skilled American employment. Huang told the Wall Street Journal on Wednesday that there would be a digital version of everything, just as we currently create real automobiles and anything else physical in the future. Therefore, to develop the AI model that powers the vehicle, you need an AI factory. NVIDIA has already pushed the idea of an AI factory, which is a facility that processes data and produces intelligence. It can also be thought of as a kind of one-stop shop for chips, software, design, and networking infrastructure, made specifically for AI. Since the chip company is the brains behind the AI infrastructure, NVIDIA stands to gain from the establishment of these AI factories, Huang added. He referred to the little data units that AI models spew out as tokens, saying that electricity enters the factories and tokens emerge. The NVIDIA CEO's remarks were made at the Hill and Valley Forum, an assembly of Silicon Valley leaders and decision-makers that was organized by Jacob Hellberg, President Trump's choice for the position of Undersecretary of State for Energy, the Environment, and Economic Growth. Hellberg is well known for taking a tough stand against China and has cautioned that businesses need to prepare their supply networks for a potential escalation of tensions between the United States and China. Washington continues to target NVIDIA's cutting-edge AI chips, which contributed to the AI boom because of its sale to China. The chipmaker warned it would face a $5.5 billion fine after the U.S. government said earlier this month that it would require export licenses for certain processors built by rival AMD and NVIDIA. Huang said that legislators must understand that we should be speeding, supporting, and promoting the American AI business globally, but he declined to respond to specific queries on Wednesday regarding the government's chip export regulations. According to persons familiar with the situation, Huang will speak at a closed-door roundtable hosted by the House of Representatives Foreign Affairs Committee on Thursday about NVIDIA's business operations and adherence to U.S. export regulations. The roundtable is one of several discussions lawmakers are holding with export control specialists. Huang added that the surge in data center development in the United States will generate skilled jobs in fields like construction, steelworking, information technology, and networking, further solidifying the notion that AI factories will become a standard feature for American businesses. He asserted that in order to establish a nation, our nation must recognize that tradecraft is a noble profession. This month, NVIDIA declared that it would begin producing AI supercomputers exclusively in the United States. This would be the first time that such devices are produced wholly in the country, according to the firm. Huang said on Wednesday, "I'm thrilled that the administration is really encouraging supporting the industry with onshore manufacturing. We will lose a massive industry if we don't improve our manufacturing skills." According to Brian Colello, a Morningstar equity strategist, America's export limitations have essentially destroyed NVIDIA's business in China. According to him, the massive chip manufacturer will therefore probably stop doing business in the second-largest economy in the world. According to Colello, Washington's move to bar NVIDIA from selling its H20 chip in China was likely the last straw for the company's ability to sell mediocre processors in the nation. He therefore thinks that Huawei, a Chinese company, can currently or soon will be able to sell processors of a greater caliber in China than NVIDIA. According to Colello, the proportion of NVIDIA's revenue that comes from China has already decreased. Furthermore, he stated that even if the company would mainly concentrate on the US and Europe in the future, it can still expand considerably. The shares have declined 14% over the last 3 months and 3.5% over the past month. Even though we recognize NVIDIA's potential, we are convinced other AI stocks have a better chance of producing larger profits in a shorter amount of time. While prominent AI stocks lost over 25%, one AI stock has increased since the start of 2025. In the meantime, after-hours trading on Wednesday saw a 1.8% surge in shares of AI behemoth NVIDIA as Hyperscaler Meta Platforms raised its capital expenditure estimate for this year once more, citing AI spending. According to Meta, its previous estimate of $60 to $65 billion for full year 2025 capital expenditures, including principal payments on finance leases, will now be in the region of $64 to $72 billion. According to Meta, this revised outlook takes into account both an increase in the anticipated cost of infrastructure hardware and extra data center investments to support our artificial intelligence initiatives. Our core business will continue to receive the majority of our capital expenditures in 2025. The announcement coincides with concerns about potential slowdowns in AI capital expenditures, as hyperscalers may attempt to reduce their expenditures by employing more DeepSeek-like technology. Some of the top AR and VR gadgets in the world are powered by NVIDIA. The NVIDIA Omniverse, for example, offers the world's first fully ray-traced, full-fidelity XR experiences. The Omniverse XR application allows developers, engineers, and end-user designers to create 3D virtual worlds at human scale. Users can transfer virtual assets into the real environment to see content via augmented reality. Similarly, users may stream AR material wirelessly with the NVIDIA Cloud RX, which provides VR and AR experiences across Wi-Fi and 5G networks. With its NVIDIA Drive AR processor, which gathers data and shows it to drivers via AR, the business is also developing technologies to use AR in automobiles. It is the third best augmented reality stock to own, according to hedge funds. Citing the rapidly growing demand for inference chips, Morgan Stanley analyst Joseph Moore increased his 2026 revenue and earnings projections for NVIDIA on April 28. The analyst remained optimistic about the stock, citing the company's emphasis on AI-driven growth and the robust demand for its GPUs as reasons for his buy recommendation. According to Moore, the business is a great choice for investors looking to get involved in the AI revolution. On April 29, Harsh Kumar, a Piper Sandler analyst, kept his buy recommendation on NVIDIA at $150. So, what implications does this have for NVIDIA's stock? Let's explore that. But first, a big thank you to those of you who've stuck with us this far. Creating these videos takes significant effort and dedication, so if you're enjoying the content, please hit the like button, subscribe to our channel, and share your thoughts on NVIDIA stock in the comments. Your support truly helps us grow. Now, let's get back to the video.
NVIDIA, it is under some pressure today along with the broader market, especially, obviously, all of this seems to make sense with the, kind of deteriorating economic picture that we're getting on the macro front, GDP contracting for the first quarter. What are your views on what the chip market will look like from here?
So, we're not in any of the chip companies at the moment. Again, if I were a long-term investor, I think NVIDIA is a must-own. I'm not in it now. We do run a 2x long and short on it. So it's something I watch very closely. I'm a bit worried about this Huawei news, but I think, after Mag 7 earnings, NVIDIA is probably something I'd want to go back into. The other chip companies, not yet, Intel, AMD, those just always seem like such dumpster fires. I think NVIDIA is the one you want to own. I'm just not sure you want to own it today.
So a bit with regard to Huawei, is the concern that they could meaningfully dent demand as it relates to NVIDIA's market share?
Yeah, I mean, to make AI work, you need NVIDIA's chips. If that changes everything. So, anytime you see news, around competition, that's always going to give me a little bit of pause. Again, I'm sure, by next week, I'll probably be back into NVIDIA, depending on how things play out. I do think they're going to be the long-term winner, but I'm certainly keeping an eye on that Huawei news.
Okay.
The Magnificent Seven stocks drove market gains last year as investors placed bets on a possible revolution in artificial intelligence, AI. With significant investments in AI, this group of leading tech stocks is well positioned to profit from the AI growth story. Apple, Alphabet, Amazon, Meta Platforms, Microsoft, NVIDIA, and Tesla are the companies I'm referring about. However, investors' interest in these once coveted companies has significantly decreased in recent years. Investors were concerned that the tariffs, which would raise prices, may harm American consumers and American businesses when President Trump announced plans to impose import taxes. The S&P 500 index dropped as much as 15% from the beginning of the year to last month's lowest point. All industries have seen a decline in stock prices, but businesses that depend significantly on overseas production have been hardest hurt. And at the top of the list are tech stocks. Despite Trump's temporary exemption of electronics from tariffs, investors fear that any levy, no matter how high, will be a barrier. And that has affected the stock of one of the largest AI winners from the previous year. Since the beginning of the year, this company's stock has dropped by almost 20%, and valuation has followed suit. Although it isn't the most affordable of the Magnificent Seven, it is now the greatest deal. Let's investigate. When I tell you that this stock is the once high-flying NVIDIA, you might be shocked. After the stock's 800% rise over the last 2 years, it's difficult to think of it as a bargain. What has caused NVIDIA to rise? Thanks to its leading array of AI products and services, the business swiftly became the most promising contender in the AI race. The most potent AI chips in the world, referred to as graphics processing units, GPUs, are produced by NVIDIA. Important AI operations are powered by these GPUs, and a high-performance GPU can significantly impact a customer's AI project results. Because of this, a few other Magnificent Seven businesses, as well as other tech behemoths, are big NVIDIA clients. However, NVIDIA has expanded beyond GPUs to create a whole ecosystem of goods and services tailored to the needs of AI users. Additionally, the business has developed unique platforms for a number of sectors, including the automobile and healthcare industries. Because of all of this, NVIDIA's revenue has skyrocketed in recent years, hitting a record $130 billion in the most recent full year. However, recent government actions that have prevented NVIDIA from selling its chips to China and worries about potential import duties have harmed demand for the company. This is due to the fact that these factors may have some effect on the company's revenue. To stay informed about the latest developments from NVIDIA and the ever-changing stock market, consider subscribing to our investing tutorial channel. We provide daily updates on significant market shifts and key catalysts, so hit that subscribe button to ensure you never miss crucial information. We'd love to hear your thoughts on NVIDIA stock, so please share your opinions in the comments below. Now, let's dive into today's video.
One issue I know front and center for NVIDIA investors too was this idea, this concern that the hyperscalers, the cloud giants, were going to start slowing down that AI spending, John. Now, Alphabet reiterated its CapEx guide. Today, after the bell, we're going to hear from Microsoft. I'm just curious how you're thinking through that dynamic.
Yeah, we are not picking up any signs that major hyperscalers are kind of slowing down. Obviously, there's a lot of consternation about what Microsoft's view is going into next year. We'll have to see what they have to say. But in the near to medium term, I am not seeing any signs of any sort of slowdown at this point. Maybe there's a few issues that we're picking up on the supply side related to NVIDIA, but the demand side looks pretty strong at this point.
Consequently, NVIDIA's stock fell, and it is currently priced at 24 times projected earnings forecasts. Even though this isn't the most affordable of the Magnificent Seven, the pricing is still very affordable. Let's now examine the factor that, as shown in the chart below, makes the stock an excellent value at the moment. This displays NVIDIA's 12-month sustainable growth rate in comparison to the other Magnificent Seven companies. This indicator shows the anticipated growth rate over time in the event that the company's financial policies remain mostly unchanged. NVIDIA has the highest of the group, as can be shown. Even if Apple is very close, it's vital to remember that NVIDIA's sustainable growth rate has been increasing, while Apple's has been slightly declining. This, along with NVIDIA's present price, makes the company appear very inexpensive right now. You could argue, of course, that we don't yet know the exact amount of import taxes on gadgets, and that if they turn out to be larger than anticipated, this could hinder growth. This is accurate. However, the other Magnificent Seven companies will also be impacted by this issue, which will negatively affect their growth prospects. As a result, they may also see a reduction in their potential earnings. This implies that NVIDIA may still be the group's best value. But aside from that, there are two more factors that give me hope for NVIDIA. The company recently announced a significant investment in U.S. manufacturing, demonstrating its proactive approach and perhaps reducing its exposure to import taxes. Second, NVIDIA is renowned for emphasizing innovation, as evidenced by their commitment to yearly GPU upgrades. As the AI boom continues, this should keep the business ahead of competitors and lead to a notable increase in revenue. There are good grounds to think that NVIDIA can continue to grow at a high rate, including its market leadership and measures to reduce the negative effects of tariffs. And because of this, and the stock's present price, NVIDIA is currently the greatest Magnificent Seven deal. At a White House event on Wednesday, NVIDIA CEO Jensen Huang spoke with President Donald Trump about the company's newly announced $500 billion deal to produce the most cutting-edge AI processors in the U.S. For the first time, all of this technology will be made in the United States. Known for redefining computers, NVIDIA wants to build cutting-edge manufacturing facilities in the United States by utilizing robotics and artificial intelligence. Given that the computer architecture hasn't changed much since the 1960s, Huang emphasized the importance of this technological advancement. He underlined that the next level of computing is represented by the new NVIDIA processors, which weigh 70 pounds and include 60,000 pieces. These chips are so complicated that sophisticated robots and even a supercomputer are needed for both testing and manufacture. The CEO of NVIDIA claimed that modern production is propelled by technology rather than cheap labor, and attributed the acceleration of U.S. manufacturing to President Trump's leadership and policies. Huang thanked the administration for its assistance, which includes an industry-focused energy strategy that is crucial for the development of emerging sectors like artificial intelligence. According to Huang, the Trump administration's backing is essential to developing the emerging AI sector, which he predicts could transform a number of industries, including healthcare, finance, and education. He emphasized how crucial it is for the U.S. to have the basic AI infrastructure in order to foster innovation in these sectors. With the potential to revolutionize the fields of manufacturing and artificial intelligence, the collaboration with the U.S. government represents a significant milestone for NVIDIA and the technology industry. The White House event provided an opportunity to highlight the administration's and NVIDIA's joint efforts to influence the direction of AI and American industry. To stay informed about the latest developments from NVIDIA and the ever-changing stock market, consider subscribing to our investing tutorial channel. We provide daily updates on significant market shifts and key catalysts, so hit that subscribe button to ensure you never miss crucial information. We'd love to hear your thoughts on NVIDIA stock, so please share your opinions in the comments below. Now let's dive into today's video.
Markets correspondent here on Schwab Network to set up the action for today. All right, we just finished out a month different than how really the month began for April. It was incredibly volatile, especially in the early part of the month. We were briefly in bear market territory. Just how would you characterize how we finished things and kind of where we are today?
I mean, obviously, we finished off really strong. You know, the S&P 500 did not in the month positive, but if you're looking at the NASDAQ 100 or the NDX, it got pretty close to in fact, actually, turning positive for the month here. And obviously, we have a lot of this enthusiasm when it comes to these earnings announcements here. And as you said, technically, we did actually go down to that 20% level for the S&P 500, but we were able to recover here. I think the risk that the market has seen when it comes to tariffs has probably been priced in for the most part here. And then the earnings side of the equation here is actually looking pretty decent when you're looking at the Mag 7 companies. And so we've seen this type of reaction before, actually back in around October to November of 2022, early 2023. The technology stocks were able to kind of lead the way here, even though we may have seen some weak economic data that impacts companies that were in the consumer staples and consumer discretionary sector here. So what you need to have as far as this market to continue to move higher is the bigger companies, the market cap weighted companies that really do have an impact on the S&P 500 continuing to move higher here. And it's going to be very hard for the bears to try to knock this down for now. The economic data that we had yesterday, Diane, I would say for the most part was neutral to bearish, and we did see the initial reaction. But once again, there's a lot of buy the dip mentality here, and market is more enthusiastic, it seems like right now, when it comes to artificial intelligence and tech, more than probably focusing on the economic landscape at the moment.
It surprised me that you saw, ultimately when we got towards the close, just shaking off that economic data, shaking off the news that the economy contracted in the first quarter, and then that weaker ADP report. I know it's not the NFP print, but it does show some, deterioration in the economic landscape. When you think about, obviously, besides earnings, tariffs has been top of mind recently. We're seeing that Treasury Secretary Scott Bessent doing an interview with Fox Business this morning saying talks on the table with Japan next. Does the attention, is it all about big tech now? And we're going to get into the numbers on Microsoft and Meta, or is this, tariff getting a deal on the table matter more?
Yeah, that's actually a really good question. So a couple of points just to kind of focus on. One, yesterday was also month end. We have to be mindful of that, Diane. If you kind of go back and look at the charts since October of last year, pretty much every single month end has had a wild ride to the upside. We see a flush to start off, and then you do see the tape being, printed higher. And so we have to be mindful of that with some of that price action that you were kind of mentioning yesterday. I think some of it was probably more mechanical than it was new speculators kind of getting into the market, portfolios rebalancing here. From a tariff standpoint here, we have to also just be mindful anytime that we have any type of shock to the market and we have an event like tariffs, Ukraine-Russia conflict, what have you, over time the market starts to price that in, and it starts to kind of look, I don't want to say look past it, but they know that there is a little bit of an issue there. The thing for the market right now is that they are looking for the news flow, the positive news flow, and hopefully everything incrementally gets better over time as far as these talks. I think it's unrealistic for for us to say that we will see a concrete trade deal that's passed by Congress by, in the next 6 months or so. But you'll probably start hearing a lot more announcements when it comes to frameworks that are going to be out there, non-binding trade agreements. That's what we saw in the first Trump administration. As we see more of that conversation taking place, I think that's going to be incrementally better for the market until we see a really dramatic drop when it comes to the economic data. Now, I also kind of want to point out, when you're looking at GDP yesterday, yes, it came in negative. There's a wide range of estimates that were out there. And you are seeing some people that are nitpicking as to why that actually occurred. Net imports, when you're kind of looking at it, had a massive drawdown when it came to the GDP number. And when you're looking at inventories, and if you calculate the numbers, you say, hey, there's a portion that is missing. And the portion that's missing is intermediate goods, which are not actually calculated in GDP because you would have this double count type of situation going in, meaning that we had companies that were bringing in raw materials to produce products, but until those products are actually final goods, they're not going to reflect. So you're going to see a massive readjustment this quarter coming up, the Q2 numbers. You're going to see a massive readjustment where imports are going to probably fall off a cliff, and you're going to see inventories really stack up and rise. And so you're going to see probably more of a positive print for Q2 right now, if consumption continues to hold up. And that's why probably the market also said, okay, knowing those factors, maybe that number that we saw yesterday was not as bad as we may have feared.
And then let me ask you this, crude oil below $57 a barrel, under pressure. What does that tell us about the economic picture?
Yeah, crude oil is telling you that we are having an economic slowdown. You can make the case that, yes, we are seeing some new production being put online by OPEC Plus. There was a report that Saudi Arabia stated that they are okay with lower energy prices. But at the end of the day, the production that OPEC's bringing back online is not enough to really push these prices lower as aggressively as we are seeing. It's not that monumental of an impact. So you're seeing a lot of bearish takes on crude oil. It is pricing in a slowdown. And the trajectory that we are seeing right now, you can make the case that we could break that $50 level, maybe hit $45, $47 until maybe some buyers start to step in. But that's just the case that's going to be taking place. On the back end of that, you are seeing natural gas actually rise because of those crude oil prices moving to the downside. So we will see prices at the pump starting to go down a little bit. You're not seeing the direct relationship between gasoline prices moving lower and futures and what we're seeing at the pump, but you are seeing a little bit of that taking place. But what will also happen, Diane, is utility prices throughout the summer most likely will actually rise at a pretty healthy clip because the constraint of natural gas, which is a byproduct of shale production, is also going to draw down on supply, which is once again going to push prices higher.
Okay, so let's talk about some of the bullish sentiment. Let's talk about what we're seeing from Microsoft first. Shares rallying right now. Recap the numbers for us, KG.
Yeah, we are seeing a nice little pop for Microsoft here, up over 9% to start the session off. When you're looking at the numbers that they reported here, they actually beat both, obviously, on the top and bottom line here. Adjusted earnings per share came in at $3.46. Street was looking for $3.20. Revenue also exceeded the Street's expectations pretty much by about $1.5 billion here, coming in at $70.07 billion. Street was looking for around $68.3 billion here. Revenue growth was around 13% on a year-over-year basis. And when you're looking at the key areas of their business, for Azure revenue growth, we saw that hitting at around 33% on a year-over-year basis. Street was looking for around 30%. Intelligent Cloud also exceeded the Street's expectations here. And also when you're kind of looking at their, the Windows unit and Xbox and things of that nature, which has been a little bit lackluster, that also beat the Street's expectations here. Guidance, they are looking for next quarter revenue to come in between $73.15 billion and $74.25 billion. Street was looking for $72.26 billion. So they beat by about $1 billion on the top line revenue guide for next quarter. And revenue or Azure growth, they're looking at around 34 to 35%. So they're actually seeing more of an acceleration when it comes to Azure. CapEx spend, you did see a slight increase when it came to CapEx spend. We got to be mindful, too, a lot of the commentary on these conference calls. Yes, some of this is going to be organic growth for AI and data centers, but the majority of these increases are trying to reflect the increase in cost for building out these data centers, these GPUs, because of tariff policy. So there's a bright spot there, but it's a little bit more watered down when you're looking at the CapEx spend expansion